Welcome back to Data Brief, where we help you make smart, data-driven decisions for your investments. I'm Eli Freman, and today we're tackling a big question. How much cash is too much cash to hold as an individual investor? Let's look at the data. Now, we all know that cash provides security and flexibility, but is holding too much cash actually costing you? Today, we'll break down the role of cash in your financial plan, why it's important, and most importantly, why holding too much cash could be holding you back. And stick around for the 4 reasons why alternatives are better than cash. Let's start with why cash matters. Cash is essentially in every financial plan. It's your safety margin. Imagine you lose your job, face unexpected medical bills, or have a major car repair. That emergency fund gives you the peace of mind so that you don't have to liquidate investments at a bad time. But how much do you really need? Well, the general advice is to have somewhere around 3 to 6 months worth of living expenses in an easily accessible savings account. According to the Federal Reserve, almost 40% of Americans can't cover an unexpected $400 expense without borrowing money. So if you've built up that cushion, you're already in a stronger position than most. But beyond that emergency fund, holding more cash than you need might actually be weighing down your long-term financial growth. Here's the deal. Cash feels safe, but in the long term, it's actually a risky play. Why? Because of one thing, inflation. While cash sits in your savings account, inflation is constantly chipping away at its value. Historically, inflation has averaged somewhere around 3% a year. So let's look at that math. $10,000 left in cash 20 years ago would have about $6,200 worth of purchasing power. That's about 40% less than it could have 20 years ago. Holding cash also means you're missing out on potential investment gains. If instead of holding $10,000 in cash, you'd invested that money in the stock market with an average annual return of 7 to 10%, you could have seen that grow to $38,000 in the same 20-year period. So while cash feels like it's not losing value, it actually is, slowly but surely. So if cash isn't the best long-term strategy, what are the alternatives? Let's dig into a few options that provide better long-term real returns. Remember, real returns are the returns of the investment after you subtract inflation. As a note, these investment options produce real returns but are all considered riskier than cash. Number 1, bonds. Bonds are a solid alternative to cash if you're looking for a little bit more stability. Government and corporate bonds typically offer higher returns than savings accounts, but without the wild swings of the stock market. For an example, U.S. Treasury bonds have historically provided returns of around 2 to 3% annually. It's not huge, but it's enough to outpace inflation, making it a better option than holding cash. Plus, bonds add diversification to your portfolio, reducing your overall risk. Vanguard highlights both of these points in their study called Why Bonds and Not Cash Endure in Retirement Plans. Take a look at the projected 30-year returns for equities, bonds, and cash. On the left, you can see that equities range from a target of 4.8 to 7% real returns. And in the middle, you can see that bonds range from 4.2 to 5.4% real returns. And for cash, you can see a range of 0.8 to 1.9% real returns. This goes to show that holding bonds is a middle ground of expected returns between cash and stocks, but also is likely to outperform cash on a total and real return basis. Furthermore, Vanguard makes a case against cash as a good investment in times of economic turmoil. They state, when the economy begins to slow and equity markets sell off, there's generally a reduction in the federal funds rate to help spur economic growth, which would decrease the return that you would earn from your cash investments, while ultimately helping the bond market because bonds typically rise in value while rates fall. Let's look at the chart by Vanguard showing since 1994 the 12-month returns of cash and bonds when equities or stocks had a negative year. You can see that cash had an average return of 1.4%, while bonds produced an average return of 7.6%. And on the 2 bars on the right, you can see a portfolio using cash versus bonds in the periods when stocks were down. Other considerations that are not anywhere close to the risk characteristic of cash would be something like real estate, stocks, and business ventures. All, if done properly, can produce outsized real returns from cash, but you're taking a lot more risk to earn those returns. If they're so much more risky, why are they better than holding too much cash? Well, here's 4 reasons why. Number 1, inflation protection. Cash erodes in value over time due to inflation, like we've talked about in the video. Bonds, stocks, real estate protect you from inflation in a better way. For example, A dividend-paying stock not only pays you in cash, but also has the potential to appreciate in value, beating inflation on two fronts. Number 2, compound growth. Investments grow over time through compounding. The longer you leave your money invested, the more it works for you. Compounding means earning returns on your returns, and over decades, it's the single most powerful force in growing wealth. Cash doesn't compound, it just sits there. Number 3, diversification. By moving excess cash into a diversified mix of assets like bonds, stocks, or businesses, you're spreading your risk. A diversified portfolio is less likely to suffer massive losses compared to holding just one asset like cash. Number 4, long-term wealth building. If you want to build long-term wealth, you need to be in assets that grow over time. The stock market, bonds, and real estate have all shown steady, long-term upward trends. Cash, on the other hand, is guaranteed to lose value when inflation is factored in. So the question isn't, can I afford to invest, but can I afford not to? Think of cash as your financial defense. It's important, but no one ever wins a game playing only defense. To win, whether that's reaching retirement comfortably, buying a home, or building a legacy, you need to have your money working on the offense too. Let's go back to the question I asked at the beginning. How much cash is too much cash? Once you've built up your emergency fund of 3 to 6 months worth of living expenses, you should consider allocating the rest towards investments. To wrap it up, cash is an essential part of your financial plan, but holding too much cash can hurt you in the long run. The data is clear. Between inflation and missed opportunities, too much cash is like leaving your money on the bench when it could be in the game. And if you want to know what else is a bad investment, click here.